Stop sending money home. I know it's part of our culture, but it might be the very thing keeping you broke. Hidden fees and constant pressure to send more are draining your wallet and stopping you from reaching the financial freedom you came here for. So what's the real cost of sending money back home? And how can you take control? In this video, you will learn about the hidden fees and exchange rate markups that reduce the amount your family receives. Why prioritizing your own financial health is crucial, and practical tips to reduce transfer costs while investing in your future. If this is your first time here, welcome. I am Christine, and as always, I am here with my beloved
Wachuku, Vidal Wachuku. You're welcome. And additionally, we are also licensed financial professionals.
So, on Cash Talk for Immigrants, we help African immigrants navigate the US financial system and build lasting wealth. If you find value in today's video, please like and subscribe. It really helps the channel grow. Now, let's dive in.
In 2023, immigrants sent a staggering $72.5 billion in remittances to Africa, according to the World Bank. Nigerians alone accounted for 19.55 billion with a big B, followed closely by Egypt with 19.53 billion. Nigeria never comes last, but
Nigeria no dey carry last.
Exactly, as we will say back in Nigeria. But here's the real question. What's the actual cost of sending all that money? Note that it's not just the amount you send.
Yes, many of us overlook the hidden financial drains, starting with transaction fees. Whether you're using Western Union, MoneyGram, or other online services, these fees can eat up 3 to 10% of every transaction. So let's say you send $200 every month. That's $20 in fees. Multiply that by 12. That's a whooping $240 in addition to the $2,400 you sent that year. That adds up fast. Hundreds of dollars lost each year.
Wow. Well, next, let's talk about exchange rates. Have you ever noticed that the rate you get when sending money isn't as good as the parallel market rate? That's because these companies tack on a markup or use the official rates, and it means less money for your family and more profit for them. Over time, that really adds up.
Yes, but here is where the real damage happens. Every dollar you send back is a dollar you're not investing in yourself, your future, or your financial security here in the US. It's like the safety instructions on a plane. Put on your own oxygen mask before helping others. Why? Because if you can't breathe, you can't help anyone else.
The same principle goes for money. Making sure you are financially stable first doesn't necessarily mean you're abandoning your family. No, it only means you'll be in a stronger position to support them in the long term. Even the Bible says, love others as you love yourself. So it starts with self. But too often, we are so focused on caring for our families back home that we neglect our own financial health, which is what we should be doing.
Yes. If you're sending hundreds of dollars a month back home, that could be money used to build wealth through investments, create an emergency fund, save for retirement, or even start a business. Now, don't get us wrong. We are not saying stop helping your family.
Yes, sir.
But there are smarter ways to do it without putting your own financial future at risk. All right, here is how.
Be honest about the realities of life in America. Many of us live a fake life.
Yes.
And many of our relatives back home think living in America means picking money on the well-lined golden streets. But they don't know the reality that you have to pay constant bills and taxes. Share your true struggles. Stop feeding into the American dream narrative on social media. Stop making them think all is rosy. Stop living a lie. Tell them about your rent. You know, when I told someone back home what I pay, He was shocked and he exclaimed, "That's how many million naira?"
Yeah.
I'm from Nigeria, so we use naira.
Break it down for them. Tell them about the rent or your mortgage, phone, internet, gas, water, utility bills, home insurance, homeowners association fees, home maintenance costs, and all the rest. Let them know most people in America are working hard just to pay bills, not living the glamorous life they see on TV. Tell them that here you cannot owe taxes. You could go to jail for that, or even rent or utility bills, as they can do at home without consequences. You pay or you're out in the cold.
And driving a car is not as simple as it appears. There are monthly car payments because not many people can drop 30,000 to 50K upfront to buy a car. Inability to pay those monthly payments results in repossession. There are also compulsory annual registration fees, smog checks and high gas prices, car insurance, and of course, tickets for traffic or other offenses. Then add federal and state taxes, social security deductions, which you may not even benefit from, and sales tax on everything you buy. Life is about constant work to stay afloat.
Yep. So how do you take control? Set a budget. Determine an amount you can afford to send each month without hurting your own finances. Stick to it, no matter how urgent the request seems, whether it's a family emergency or a story like grandfather swallowed a spoon. Yeah, your financial stability comes first. And trust me, they will find a way to take care of the so-called emergency.
Use low-fee transfer services. Not all money transfer services are created equal. It's important to choose one with lower fees and better exchange rates so more of your hard-earned money reaches your family. Wise is a great option, offering low, transparent fees and a real mid-market exchange rate, which can save you more compared to traditional banks and other transfer services. If you are sending money home, Wise is an excellent choice.
Yes, check out the link in the description below to get started and save on your next transfer. By using our link, you will not only enjoy Wise low fees and real exchange rates, but you will also be supporting our channel as we receive a small commission at no extra cost to you. Sign up with Wise today and start saving. And if you'd like a step-by-step video on how to use Wise, including all its benefits, just comment Wise below and we will make that happen.
At the earliest opportunity, acquire what we call the American Survival Kit. One non-negotiable tool in this survival kit is health insurance. It's a major cause of bankruptcy in this country. Medical bills, they are high. I remember when I had what I thought was an ordinary chest pain, and it cost me a whooping $12,000 ER bill. What saved us was that after 3 years in America, we had just gotten our health insurance for the first time that year.
Yes, though our copay was only 20%, it was still a $2,400 out-of-pocket payment. This bill was settled via a payment plan. Now imagine if we didn't have health insurance. That's $12,000 bill we could have immediately, it could have sent us immediately into a huge debt. The next strategy is invest in yourself. Before you send money back home, think about your long-term goals. Build an emergency fund because life happens, like that unexpected medical bill. Also, an unexpected job loss could happen. Though you can apply for unemployment benefits, they can take several weeks to process.
Also, unplanned transitions such as death or divorce can happen. Natural disasters, in America, such as fires, floods, tornadoes, hurricanes, ice storms, blizzards, and earthquakes can cause very expensive repairs. This is why you need an emergency fund. Contribute to your retirement and put funds in assets that can grow your wealth. Remy came to the US at 20. And, she opened what is called an Indexed Universal IUL policy at 22. Now, if she puts in just $200 a month into this account, by the time Remy is 35, her cash value would be over $39,000. Wow. She could use that money for a down payment on a house or even start a business. Now, if you notice, at 42, by the time Remy gets to 42, she would have contributed about $48,000 into this account. But recall that she had already taken $39,000 when she was just 36 to do some other business, or probably as a down payment to purchase a home. Now, keep in mind, this amount is from the non-guaranteed column of what you are seeing on your screen, because the cash value of an IUL is linked to the performance of a market index like the S&P 500 or the Morgan Stanley US Equity Allocator. What insurance companies do is that they track the index and use it to determine the interest rate applied to the policy. This means the cash value can fluctuate. So the amounts mentioned could be higher or lower depending on market performance. That is why they are non-guaranteed. However, a 20-year historical performance shows that most of these accounts actually outperform the illustrated rate. If you see the illustrated rate here is 6.44% that it gives you in that non-guaranteed assumption. But in a 20-year performance history, it shows almost 7 to 8%, so much more than what is illustrated. Okay, now at 69, Remy could begin, asked to say, I want to start taking out $32,000. Retirement age here is 65, right? Now, remember, she has other sources of income. This is just something that she was just putting aside $200 every month for 20 years, right? She has other sources of income. But at 69, she can say, hey, let me start taking out $32,000 a year from this particular account. And she can do so until she's 93. Now, imagine she's taking out all this money, which totals $856,873 by the time she's 93. She has taken out $856,873. That's almost $1 million, folks, that she would have taken out. But even at that point, there is still a remaining balance of over $108,000 in that account. So even if Remy were to pass on at that age, her family will get $108,000 plus. Now, that's not just the end of it all. We are just starting. If Remy should fall sick, for instance, if she should fall sick, it comes with riders, with living benefits. It comes with living benefits. And these living benefits comprise 3 riders that it automatically comes with. And this will help to cover medical costs also. For instance, look at, again, what is before you. The first benefit you see there is the critical illness rider. Now, this rider gives the policy owner access to 100% of the death benefit of the policy. So 100%, like that 108,000 that was remaining. Remember, we are talking of Remy. She's 93 now. She has taken 856,873. She has 108,000 plus remaining. She falls critically ill at this time. And critical illness here is defined as to include, but not only, heart attacks, strokes, major organ transplants, end renal stage failure, or what you call kidney diseases, or even cancer. So she's taking all this amount of money. So from that 108, she has any of these things, she can say, hey, you know what? Give me the 108,000 that is remaining. Let me use it and treat this sickness that I have. And they will give it to her. It's her money. Of course, it depends on the reason. She may take it all, depending on why she opened the policy. Or she can just take some of it. She doesn't have to take it all, but she can't take all. Now, the second thing that you can also see is terminal illness rider. Yeah, you know, terminal illness, one of those diseases that they tell you that, hey, you are not likely to survive. With this type of policy, if Remy was diagnosed with any terminal illness that could last up to 24 months, that's 2 years, with this particular policy, with this company, for instance, Remy would be able to say, give me the entire amount of money remaining also. Let me use it and enjoy myself. You know, she's been told she has 12 months to live, or even 2 years to live. She says, give me my money. She takes a cruise around the world. She goes to enjoy herself before she dies. That's why if that is her reason for opening that policy to use it on herself, then it has served its purpose. Always remember, she has already taken $856,000 from this account. Tell me, what did she put in? $48,000. Putting in $200 a month over a period of 20 years. Wow. You know, when we saw this thing, when we heard about it, we knew about it, we immediately took out the policy ourselves. At a much older age, sad to say, we didn't know about it early enough. But we took for ourselves, we encouraged our daughters to take, we took out for our grandchildren. They are the ones that will enjoy this because all our 3 grandchildren have these policies. So they are going to enjoy it. I remember we talked about Remy at 20. She took it out at 22. Imagine us having taken out those policies for our grandkids at ages 5, 4, 3, 2, and 0. Imagine what they are going to enjoy. And there's still one more rider there that I hadn't covered, the chronic illness rider. Now, Remy could also accelerate up to 25% of the policy's death benefit. In this case, using the illustration, the example we have used, remember Remy has already taken $856,873 from this account, and she has over $108,000 remaining in it. So she could still say, hey, cut me a check of 25% annually to take care of chronic illness. Now, what is chronic illness? It's been defined as inability to do 2 of the daily living activities. Remember, Remy is 93 now. She's probably unable to brush her teeth, unable to feed herself, or use the bathroom, or do any of those daily living activities, wash herself and all that. Then she can request for this 25% of this money, of this 108,000 remaining, and she would be able to use it annually. And remember, the account is not static. It is still growing. So her money doesn't get exhausted. She's still able to use it, and money is still growing in the account. That is the beauty of what Remy could do. And you know what? How did she achieve this? Just by putting in $200 a month from age 22 to when? Age 36. $200 for 20 years, a month, putting in a total of $48,000. Look at all the benefits that come with it. These are some of the tools that are available that people don't know anything about. You want to know more about it? Let us know. If you are interested in knowing how this works, you can click on the link below for a one-on-one appointment, and we'll get you started. By securing her own financial future, Remy is in a better position to help her family back home because she could have used that money for that purpose, anything she wanted. You can also invest in the stock market and in real estate as part of your portfolio. The key is not to have any disposable income lying around.
Yes.
Remember that the example we showed you with that illustration on the screen is a hypothetical case. It's not an actual case because we are not able to show you an actual client's case. But we have these policies ourselves. So as I say, if you want a one-on-one, come to us, and then we will even show you our own policy that we can do and show you how it works. Now, By securing her own financial future, having done all these things, Remy is in a better position to help her family back home in the long run. You also can invest in the stock market and also in real estate as another means of investment, not just what Remy did, the example we gave you. The important thing is not to have any disposable income lying around. That's why you would easily send money, because you have disposable income.
Lying around.
Exactly.
But sadly, many do not even know about some of these tools we're talking about and investment channels designed to make life easy for them. At the end of the day, sending money back home is a meaningful part of our lives as immigrants. It's an act of love, care, and responsibility. But remember, you can't pour from an empty cup. If you don't take care of yourself financially, you won't be able to sustain your support for your loved ones in the long run. It's not selfish to prioritize your financial future. It's smart.
By building your own stability first, you are setting yourself up to be a continuous pillar of support for those who need you.
Yes, the truth is the hidden cost of sending money back home can silently drain your finances if you're not careful. But by setting a budget, being transparent about your situation, and making smart investments in your future, you can find the balance.
A balance where you can thrive in America and still support your family back home without sacrificing your own financial security. Remember, it's not an either-or situation. You can actually do both, but it starts with being financially smart and intentional and wise.
Yes. If you're ready to take control of your finances and create a budget that works for you, check out our next video, where we show you step by step how to budget effectively as an immigrant. Trust me, this will be a game changer for your financial journey.
Remember, come on, hit that like button and subscribe for more tips on building financial freedom as an immigrant.